Has Warren Buffett lost his mind, or is he simply seeing something that nobody else is right now? And should we even listen to him after his recent underperformance? Maybe he's lost his touch. After all, he is 95 years old. And should the stock market be worried, as Buffett has sold stock for the past 11 quarters straight? That's going back all the way to 2023, and now they're sitting on a cash balance of $347 billion. This is absurd. This is crazy. It's a lot to cover, so let's get right into it. All right, so first, a real quick history of Warren Buffett. He makes a lot of good investments, makes a lot of money. So good at investing and making money that he's known as the Oracle of Omaha. Now, that's quite a high praise, because an oracle is a medium in which God himself speaks or teaches through.
Warren is an oracle. He tells you to subscribe for Warren.
So we label Warren Buffett as a priest of God, essentially, in the investing world. Whether you want to go as far as calling him omniscient or a god, I think we can all agree on one thing, and that's he's really good at it. Some of these godlike investments that he received from the Word of God himself include Coca-Cola, his obsession started around 1988, and Apple in 2016. These investments proved to be life-changing. In his pure dedication to these companies through thick and thin, whether it be short-term pullbacks, long-term pullbacks, crazy volatility, business-altering decisions by executives, it didn't matter. He was there and he reaped the rewards. However, as we mentioned, he has underperformed the market as of late. And as we mentioned, has been raising cash like no other. Like it's nobody's business. To put into perspective just how much cash this is, if we look at a list of the companies of the entire world ranked by their current market cap, we can see a lot of big tech companies. There's actually Warren Buffett's firm, Berkshire Hathaway. And if we scroll down just a little bit more, Berkshire Hathaway's cash pile right now would rank as the 27th largest company in the entire world. We can see, like, these are massive companies we're talking about. We're talking about massive healthcare company, massive bank, one of the biggest companies in Japan, oil, Coke, GE, the company that actually makes the machines that make semiconductor chips, AMD, a massive chip maker. These companies are absolutely massive. The Bank of China is under here. So it shows, I mean, the amount of money that they have on the sideline right now is just startling. I think this is even more ridiculous. We just looked at companies, and yeah, you could say, oh, well, that's a lot of cash. They're worth more than a bunch of companies. No, let's look at countries. Countries by GDP. We can see that Warren Buffett in Berkshire Hathaway would sit at roughly the 44th largest nation in the world by GDP. What is a man going to do with all this cash? He could literally start a small to medium-sized country, buy an army, buy all the business infrastructure he would need to create a livable sovereign nation. So that's a lot of cash. We get it. It's a lot of money, a lot of moolah. So what's the deal? Why does he have so much money on the sidelines when the US stock market is right near all-time highs? This seems like a bad omen, right? Like, why is he selling so much, especially right now? And is that a warning sign we should be paying attention to? So to understand that and answer this question, we have to look at exactly how Buffett invests. What strategies does he use? What things does he look at? What dynamics does he consider when making investment decisions? I will say he keeps it incredibly simple. He relies on fundamental analysis. What should or what is the fair market value of the asset that he's investing in? Buffett is notoriously known for his obsessive nature with fundamental analysis and investing in businesses, not stocks. He even says right here, as far as you are concerned, the stock market does not exist. Ignore it. What he means is the reason you're buying a stock is to invest in a business, in a company that has some moat, some competitive advantage in their industry that will ultimately allow them to thrive and become one of the best companies in that selected industry. And you can clearly see, I mean, the quality and the performance of some of these companies that he's been holding now for 5, 10, 15, 20, 25 plus years, these are some seriously quality companies that have some competitive advantage, some strong moat over their competitors. How would you go about identifying companies with these moats, with these competitive advantages? Well, you have to look at the fundamentals. Those things include the income statement, the balance sheet, the cash flow statement. Look at key metrics and ratios to compare relative valuation of companies to other companies in the industry. Do some companies enjoy a hefty premium compared to others? Are some companies just so much more quality than others that they deserve a higher PE ratio? To really simplify it down just to one boiled down statement, short-term movement doesn't matter. And he doesn't really care about the stock market at all. The only thing he cares about is identifying quality businesses. And as we see in this chart, he tends to favor investing in these quality businesses when that blue line gets closer and closer to the green lines. When that line gets closer to the green lines, it's usually indicative of a panicked stock market or individuals selling companies that are quality businesses at pretty cheap prices, and vice versa. When the line gets closer to that +1 or +2 standard deviation, the orange and the red lines, things are starting to get a little more dicey, a little more pricey. I like that rhyme. It's getting frothy. People are really starting to lose track of just how much they're paying for these businesses. And if you've never seen this chart before, it's a good one. It's become known today as the Buffett Indicator. It actually wasn't created by Buffett himself, but he acknowledged it many, many years ago and stated it is probably, and I quote, probably the best single measure of where valuations stand at any given moment. So clearly he puts a decent amount of weight in his investing decisions in this chart right here. And if you're wondering exactly what this chart entails, it's simply the market cap to GDP ratio. Simple English, the total value of the stock market over the total value of all goods and services produced by the country. How much are people willing to pay for the stock market? Are they willing to pay, in this case, look, we're right around the 200% level. So today we're willing to pay 2 times our country's overall GDP for stocks on the market. And clearly, at least relatively speaking, that's a very, very high level. We can see that it's 57% higher than the longer term trend. We're nearing that, the danger zone, I guess is what we'd call it, right? And he really does practice what he preaches because this lines up really well with his obsession on fundamental analysis. Who cares about what happens in the short term? There's going to be up and downs. There's going to be volatility. There's going to be emotions flying around, people selling, losing money, buying, making money. There's going to be all sorts of things happening. But at the end of the day, all that matters is can we buy the best companies at a good deal? This chart continues to get really, really close to that all-time high. I mean, we were at an all-time high until this last little drop. It's clearly reminiscent of his recent behavior, right? He's raised $347 billion. He could build a country with that money. So clearly he's a little, not pessimistic, but let's say cautious, let's say weary of potential future returns. So after all of this, is Buffett right for selling? Maybe yes, maybe no. We don't have a crystal ball, but it's clear Buffett is fundamentally concerned with the current valuation of the market. And using this metric, as we just talked about, I mean, we're at some of the most, if not most, expensive levels in history, comparable to COVID, the dot-com bubble, and many years throughout the 1960s and 70s. And one thing we have to make sure we understand is that obviously no indicator is perfect. These levels could sustain for some time. We saw this way back in the 1960s and 70s. So who knows? I mean, we could continue to rally into 2030, 2035. We don't know. But all we do know is we haven't seen these levels before, and that should make us at least somewhat weary and cautious. And again, I don't think this means that there's zero investing opportunities out there. I think more so it's like, all right, let's not buy Pepe and Fartcoin, and let's not buy those shitty meme stocks. And I didn't even want to do Cole's justice here. They're having some serious problems, and I got some blurry image, one of the first images I saw on Google, another meme stock. So again, rather than buying dying businesses and hoping, for a short squeeze or some meme stock powered rally, it's more like, hey, just be more cautious. look for better opportunities, and do your research. And if you do have some sort of systematic or algorithmic program that identifies some opportunities in Pepe and Fart, then all power to you. But other than that, probably should stay away from these things. And honestly, right now, it's not worst case to have a ton of cash because, I mean, you're getting 4 to 4.5% in money markets. So if you really do believe, like Buffett seems to, potential returns in the future are much lower, then cash is a good option. And 4 to 4.5% on nearly $350 billion, it's a decent amount of cash. Many of us would be happy with that return. So we understand where he sits and why he's making some of the decisions that he is. I think it's important quick. Let's just jump back to his underperformance. If we zoom out here, remember, he's all about the long term and staying the course. I mean, yeah, 1 year he's underperformed the S&P by about 6%. But if we go back some more time, 3 years, he's beating the market by 11%. 5 years, he's up almost 50% on the market. 10 years, let's just look at the 20 years. He's almost doubling the market over that time frame. So clearly the man, although not literally an investing god, as some may treat him, the Oracle of Omaha, the dude is pretty damn good at what he does. There's really just not much more to say on that front. I think regardless, this is quite an ominous sign for Buffett's firm to be just absolutely piling on cash. And that's a lot of cash that could be helping stocks move a little bit higher right now. So what do you think? Buffett is 95 now. Do you think he has lost a little bit of his charm? Do you think the concept of fundamental investing has been lost? Do fundamentals even matter anymore? I mean, we have some valuations today in companies like Tesla and Palantir that are phenomenal companies and positioned to take advantage of these incredibly potent industries like AI, automotive, robotics, and whatnot. But they're really expensive. There's some really expensive tech companies out there. So have valuations of companies just fundamentally changed for good? Is this time different? And will people's willingness to pay these premium prices for the stock market continue to be the case? I guess we'll have to see. Let me know what you think, and I hope this helps.